Part 3 of this presentation deals with the treatment of ending inventory related to intra-entity inventory transfers under the equity method. Deferral of unrealized profits in inventory. Now there's going to be transactions between the investor to the investee, which is called a downstream sale. And then there's going to be transactions where the investee sells to the investor, which is called an upstream sale. Profit on unsold inventory at the end of the period must be deferred until sold to an outside party, regardless of whether it's downstream or upstream. So let's take a look at an example. Say, for example, we had unrealized gains in inventory. So we have an investor that has 200 units of inventory with a cost of $10,000. Let us assume that the investor sells the inventory to a 25% owned subsidiary for $12,500. 60 of the original units, or 30%, remain unsold to an outside party. We must defer our share, which is 25% of the original profit of $2,500, which is the $12,500, minus the $10,000 that it cost. So we have intercompany profit that is unrealized. So again, the investor, who owns 25% of the subsidiary, sold $10,000 worth of goods to the subsidiary for $12,500, and at the end of the period, the investee still has 60 of those units left. So they've sold 140 to outside parties, but they still have 60 left. So let's compute the deferred profit now. This is always the formula that you use. It's going to be the intercompany profit times the percentage unsold times the percentage of ownership. So it would be 2,500 in our example times 30%, which is unsold, which is 60 over 200, times 25% ownership, which means $187.50, and this was what our journal entry would look like. And in this journal entry, what we're going to do is reduce investee income and reduce the investment account. Now, in the period following the period of transfer, the remaining inventory is usually assumed to be sold. So what happens is that we need to reverse out that entry. So the reversal takes place during the period that the inventory is sold to an outside party. Now let's look at an actual example. Okay, at the beginning of 2017, Big Incorporated buys 25% of Little for $600,000. The net assets of Little at the time were $2 million. Any excess over book was attributed to a patent with a 10-year life. Little reported net income of $125,000 for 2017 and $150,000 for 2018 and paid $15,000 in dividends for each year. Big immediately started buying inventory from Little. So the cost to Little is shown for 2017 and 2018. The price charged the parent is the transfer part, and the amount left unsold by Big is also shown. So let's take a look at the journal entries used to record at year-end any deferred or unrealized gain, and then what is the balance in the investment account at the end of 2018, and what is the equity income for each year. All right, so first we're going to compute the deferral for 2017. So $150,000 is the intercompany profit. 36% remains unsold, and we own 25%, so that's $13,500 for 2017 that needs to be deferred. Now, what about next year, 2018? Well, we again take the intercompany profit times the percentage unsold times the ownership. So we have $160,000 times 35%. Times 25% gives us $14,000. But one thing you need to remember is you always have to reverse out the prior year's deferral and then show the new deferral. So the prior year is going to increase equity income and the current year is going to decrease it. So now, based on that, what is the balance in the investment account at the end of 2018? Well, first, what we have to do is figure out the amount to amortize for the patent, because that's going to affect the investment account, and it's also going to affect the amount we show for equity income. So we're first going to take a look at the consideration. Again, I converted to 100%, which gives us $2.4 million. I subtracted from the book value, which tells me my patent is undervalued by $400,000. I'm going to take that times, I'm going to divide that by 10 years, and then I'm going to take it times 25% because that's the amount that the parent is going to be able to write off each year. So the balance in the investment in little account, first we're going to take our initial investment. We're going to adjust for our share of net income for 2017. We're going to adjust for the dividends that were paid. And we're going to adjust for our share of the amortization. And we have to adjust for the deferred profit on that intercompany inventory. So we had a total adjustment of $4,000. Now we're going to we're going to record our share of the income for 2018, our share of the dividends, our share of the amortization. We're going to add back in the deferred profit from 2017. Remember to do that when you're doing your homework. And then we're going to defer profit for 2018. And we end up with a balance in our investment account at 2018 of $627,250. Now, what is the equity income? Well, for 2017, our net income would be $31,250 less the amortization, less the deferred profit. So we would have recorded income in 2017 of $77,50. Now let's look at 2018. We would show our share of the income of the sub of $37,500. We would reduce it by the amortization. We would add back in last year's deferred profit, and we would take out this year's deferred profit to get net income for the current year for equity income for the current year for 2018 of $2,700. And that concludes this presentation on intercompany accounting for intercompany inventory transactions.